Way from that discussion and into bonds for you, all the action on what's moving bond prices with Jim Stening from FIG Securities. Jim, a warm welcome to you. Let's just try and reorient briefly from that discussion for a moment and talk about APRA and the proposal to get the government on side with the banks, for want of a better word, or the other way around. Yeah. Can this be seen as a good thing, that banks should be compelled to buy government bonds?
Well, I think it's a bit of a return to the past. I mean, in previous decades where, you know, government bond issuance was large, the banks were compelled to buy bonds as part of their asset mix. And I think that, you know, by the sounds of things, this discussion paper that APRA have released is, you know, looking at those issues again. I mean, obviously, from the government's perspective, you know, finding buyers of bonds is an important thing over the coming years.
Is liquidity, though, at the moment, really a problem for banks?
Look, I don't think it is, no. But I think it's a very important component of regulation going forward, because one of the things the GFC sort of exposed was that some of those assets that were liquid, in fact, could not be liquidated. So I suppose from that perspective, government bonds, you know, can definitely be liquidated in the event of a crisis.
And yet, ultimately, who makes the judgment over liquidity? Is it the ratings agencies? Because there was a little bit of chatter in the Wall Street Journal overnight, a concern by a former Moody's employee that the ratings agencies continue to overinflate their projections on where the position of banks are right to the minute. Are you concerned by that there could be internal pressure on ratings agencies to overinflate?
Well, look, I don't think so. I mean, look, as I see it, I think that, you know, obviously the banking sector's taken a broadside over the last couple of years, and I think that a return to, you know, some sort of structure that requires them to hold top-quality assets is probably a good thing. I think there's been a bit of a backlash from the domestic banks in that they're being tarred with the same brush. They're being required to hold these assets. But arguably, I think from a rating agency's perspective, looking at the banks here, if they are required to do that, I think that that'll benefit the banks here, because I think their ratings could well increase, you know, up the scale, and therefore reduce their cost of funds over the longer term. So it'd be interesting to look at some modelling around that. And
that could, if anything, give the lie to the government having to hold on to that government guarantee for banks. If indeed they're holding government bonds, it's almost a proxy for...
Well, that's exactly right. Yeah. But also, I think, you know, if the underlying ratings are moving higher again, you know, the liability...
Bang goes that whole issue or nightmare or sweating scenario.
Yeah, that sounds like a good outcome.
And in terms of a net hit on profits, again, you'd argue it would be negligible, and if so, why so?
Well, I guess for that reason that, you know, if it does increase your security as a borrower, well then, you know, obviously that will reduce your cost of funds. So whilst your return on your assets, or, you know, your loans or your holding of these assets is lower, there's an offsetting benefit.
Is it likely to change the weighting and the reliance on overseas purchases of these bonds, specifically the Chinese? Do you think this could all be part of a strategy to shift from an over-reliance on external funding for government debt?
Look, I think it all sort of fits pretty well. I mean, obviously there's offshore demand. One of the things about our current yield curve is that it's well in excess in terms of yield of a lot of others. So, yeah, I think it's, you know, as an issuer, they're looking at domestic buyers, they're looking at foreign buyers, they're looking at retail buyers, they're looking at broadening their product base. That makes a lot of sense.
Interesting comments yesterday, just if we shift away from that now and talk stimulus, and a high-profile member of the public service, Ken Henry, Treasury Secretary, also sits on the Reserve Bank board. So here you have that wonderful, arguably, conflict of interest at play. Not to really dwell on that, but he's of the view, is he not, that rates should not really start to rise at a tentative time where stimulus is pretty touch and go.
Yeah, look, I think that's right. I think that the signals have been good. You know, economic you know, data has been good, and there seems to be a mild euphoria in the market at the moment, and confidence is renewed. But, you know, we've seen how fickle that can be, and realistically there is time. I think we've got time on our side in terms of emerging from this cycle. So things like removal of the stimulus or increase in rates, our view is that can wait a little while.
Do you see a conflict, though, Jim, and we have breached this one before, where you have a more immediate lever on policy in the form of monetary policy? The RBA can really flick that switch quite quickly, as opposed to the time it takes for fiscal, you know, policy to react. Do you see it problematic when someone of that ilk, of Henry's ilk, is sort of judge and jury on both?
Oh, no, I don't think so. I mean, I think if it's managed properly as it is, I don't see that that's a conflict. I think it's very valuable input to the decision-making process. Mm-hmm. Absolutely.
But you would agree with him that it is too early to start tightening on both fronts, fiscal and monetary policy?
I think so. I mean, you know, the stimulus has been initiated, and part of that stimulus were handouts and then this long-term initiative. So I think it's a bit like two undercoats, and we need to put the sealant on the top, so that the recovery can remain robust. I think, you know, no one is really suggesting that we're going to have high levels of growth for many years to come after the stimulus is implemented.
Mark Faber, again, and we've had this discussion with another guest today, talking about excessive credit growth and debt levels in the system, and that really not being solvable by piling up more debt. Now, if stimulus is still in the system, isn't that perpetuating that very problem that he talks about? You know, high levels of debt, if the government's encouraging people into that position, how is it sustainable?
Well, I suppose, I mean, high levels of debt are precisely why we got into the crisis, yes. I suppose.
But now we're telling more people to take on mortgages, which is another form of debt.
Well, that's right, but I think that it's a more controlled debt. I think also, you know, government-sponsored infrastructure, you know, borrowing money, you know, government issuing debt is a responsible way to go about it as well.
Can you control that debt, though, when it is so inextricably linked to unemployment?
Well, that's right. I think when you're talking retail debt, or you're talking mortgage or household debt, I think that's very much the link, and I think that obviously Australians have been spared to date in terms of this crisis on that front.
Let's move on. Let's talk corporate yields now. We talked earlier just there about government yields, as it were. Can we bring up the iTraxx, because we've seen a bit of a contraction compared with the government bond yield rising. What does that tell you there now with iTraxx ever lower?
Yeah, look, it's a really positive story. You know, particularly for borrowers or people looking to raise debt capital. We haven't seen much of that from the Australian corporates, but what we have seen is that those that have issued in the last, say, 3 to 6 months, their spreads in the secondary market have just been gapping lower. There's a lot of demand. I think, you know, there's particularly a lot of demand in the retail space. We've seen that recently. There's a lot of demand offshore from offshore entities as well. I mean, as I said, the outright yields in Australia are very favourable, and arguably the carry trade is something that's emerging as a play.
Where would that figure have been, say, 18 months ago? Because this is only for the last 6 months.
Yeah, 18 months ago, well, sort of pre-crisis levels were around 35, that sort of level. So we're still
got a long way to go.
Well, it has, yeah. But I think that, you know, there was a lot of leverage in the market back there. We're not going back there.
So I was going to say the new normal will not equate. Will it be still triple digits though?
I think it's going to hover around triple digits. I think that's a fair thing. I mean, one of the things that's happened with this index is it's just rolled over, so that one of the names that it's fallen out was a very high yielding entity, and so that's been replaced to maintain that the constituents of investment grade issuers.
We had I think it was notably Halifax last week, was it, in this space? Who is set to really make headlines in the corporate bond market in the next couple of months? Who have you got your eye on?
As an issuer, or well, I think we'll see a lot of the larger Australian entities. We could see some property-based
another Westfield.
Well, we could, yeah. I mean, they've obviously been they've raised a lot of debt recently, so arguably they don't require it. But I think we'll see across, you know, a range of sectors people coming to the market, and arguably that will provide a bit of a stability in the spreads, you know, coming in.
Brief thoughts on what emerged overnight as well. I want to get your view on the Bernanke position now. Their markets were kind of holding out for something more, one senses, than was given to them. Was that big over-optimistic in terms of a pullback?
So. Yeah, I think it was.
Because they've kept their hand in the the mortgage-backed securities market now till next year. At least.
They have, and I think, you know, obviously that was a fairly big undertaking. I mean, $1.45 trillion worth of purchases of agency debt and mortgage-backed. I think, you know, the real issue there is it's a jaw-boning proposition in that they will be removing it. People don't like surprises, so they need to flag it. You know, they've already completed 75% of it. But the interesting thing will be when they take the buyer out of the market, what will happen to those mortgage rates and the implications for the economy on that.
It seems also that we're now down to minutiae of reading these statements. If we look at August, employ all available tools, now a wide range of tools. I mean, is that finding nuanced? Is it to be read as detailed as it is?
It is. It most definitely. I mean, I think that these things are edited to the nth degree, and that change is, although it's not fundamental, it's a heads
positive.
Up. Yeah, it's a positive. I mean, that means to me that there's a slight improvement in their outlook of the economy, which is what they've sort of verbalised as well. So yeah, I mean, you definitely have to look through the wording like that.
Jim, it has been a pleasure. Thanks for the extended chat. We'll see you next week.
Okay, thanks.
Jim Stening from FIG Securities.